following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show. Thanks for joining us. And we got a little bit of new news on the Greek situation, and that's interesting and causing the euro to sell off a little bit, causing the U.S. dollar to rise, and having a little bit of elevation in the S&Ps. We're going to talk about that a little bit. And somebody's greeting me another day in paradise here. It is nice to be here, and I'm happy to be here most of the time, and I'm just ecstatic about leaving and coming back to the U.S. actually on Sunday. I'm leaving here Friday, the holiday day, and trying to travel a little cheaply, going back to Hong Kong, and spending a couple of days here with a couple of guys I need to talk to there. And then I'm going to be back, hopefully in Chicago, to do the show Monday morning with my buddy up there, Steve Dahl, in his little studio. So we're going to try to start coordinating quite a bit more, Steve and I. And Steve's a great speaker. He's a great educator. He's a lot better at getting the point across in less words than I am. So I think you guys will be looking forward to that. We're going to try to do more shows in a tandem effort also. So I think that's going to work out quite well. But another day in paradise. You know what else? Exactly. Nothing could be finer than be at Carolina. That is a great state. If you've never visited there, just do yourself a favor. Go. Mountains are awesome. The Outer Banks are insane. But something else, another kind of moniker about a geographic label. When I go to Singapore, it was if you've never been to Singapore, you also need to go there, because you'll get off the plane and you'll get in a taxi. Very reasonable taxis, by the way. Hong Kong also is, it's amazing. They're like a tenth of the price as what they are in New York. It's a trade. They're not trying to gouge you. Very nice people in those taxis. But you get in the taxi, you start riding kind of away from the airport. Changi is the name of the airport there, and you will swear you're in Disney World. And the guys on the side of the road that are digging holes, they're wearing collared shirts. It's an amazing place, very organized. But the moniker for that one is Disneyland with the death penalty. Do not bring anything into that country, and don't think about it, because it's quick. So just thought I'd throw that in. You travel around enough, you really see, especially in Asia, the cultures change relatively quickly. I mean, in the States, you go from Texas to Vermont, you're still, you could call that a sea change of attitude from Texas to Vermont. But you go from Vietnam to even Malaysia, not too far apart. You get two totally different cultures really that quick. So it's an interesting place to kind of be based and be able to kind of hop around the different areas. It's awesome, actually. And I'm a big fan of food, obviously, and there's some awesome food over here, so it's a great place to be. But let's get right into, and I'm really excited about getting back to the States, though. But let's get right into the euro, and let's take a look at what's going on here. Let's step back for a second and look at the long-term weekly view on the euro. And I did a Bloomberg brief on this and talked about, we were going to have some really good opportunities around these unfair highs on the weeklies to continue to look at this, sell resistance and sell breakdowns. And as we look at this, that's worked out relatively well, even in the midst of, just the coin flip of whether that's good or bad for the euro. If Greek exits, the fact of the matter is, in the long term, I still feel like this is going to par. I don't think a lot of good things are happening in Europe. Barring, just kind of throw the Greek thing out the window. It's a continent that really is going to have to come to grips with that. They're going to have some some real serious changes. I mean, the world competes with the world now, and when you kind of get on a level playing field, you can't really have disparities that are somehow going to continue to be there. They're going to kind of normalize. So I think we've got a caller, actually, John from Philadelphia. John, are you with us today?
John, I am. Thanks for taking the call, sir.
Hey, it's always good to hear from you, man. I'm excited that you called.
Yeah, it is so good to have you do this morning show from continents far away. I just, every time I hear you on with Tom O'Brien, his team, and this technology, I am just amazed. It never gets old for me.
Oh, awesome. I feel the same way when you get on. I always learn things when I listen to you, so I'm just excited that you called. So what's on your mind today?
Yeah, I tell you a couple of things, but you kicked off with the euro. I have a very specific question for you.
Yeah.
The euro broke into a low in January. Of course, it was December into early January when the widest price spread portion of the bear phase in the euro took place. There was a strong bounce, and then there was a decline. The strong bounce failed at 115 or so, and then there was the move from 115 down into 104 and change into March, and that was occurring right as the ECB officially launched its quantitative easing program on March 9th. Anyway, okay. So that was a low. The euro has bounced back up. The euro has failed to exceed 115. It just so happens that 115, of course, is that swing high from, I guess it would be February. And also, I keep every time you do your show and you pull up your weekly and daily profiles, I see 115, 114 is top of the box.
Right.
Question.
Right.
Now that we've failed at 115, 114 repeatedly, is there anything in your work that can suggest to you when, assuming this happens, but when a decline to go under 104 takes place?
Well, that's a great question, and thanks for going through the history of that, because a lot of people don't really, do that in their heads. They just kind of live in the very immediate now, and I think it's very important, as you do, I'm assuming, to kind of, go back in time and figure out where we've been, and some of those areas of concern in the past are definitely going to be areas of concern in the future. One of the things that I always do, and you probably are aware of this, John, is I really like to get shorter term time frame, the major week profiles. I like to kind of drill down and see where we're at relative to profiles on shorter term time frames. And you probably heard me say this so many times. I like to let I like timeframes kind of regulate trade for me on a longer term stance. And Tom and I were talking the other day. Lower term, the 60-minute, 240-minute profile on for highs and for lows, these inflection points on the short term, I like to use those as a regulation of the longer term trade, and I really don't like to put on a lot of trades. This is my personal preference until we gravitate into what I would call a high probability setup on either the weekly or the daily, and then I'm able to, in my mind at least, that I picked a battle in a high probability area, because the way we look at it is the longer term inflection points really take prevalence over the shorter term inflection points. So I just kind of, me personally, I'd rather wait till those things happen. But to answer your question, I'd like to see this thing. We have it. I'm looking at the daily right now in the euro. We've obviously had a little volatility the past 2 days, but we've got a new profile that's appeared on our daily. I'd like to see this thing for today. I'd like to see this thing break 110.91 is what it looks like it is. 110.91 unfair lows, and we're kind of getting below there right now. And then I would like to see I would like to kind of orient my stops around that inflection point and any new 240 box highs as we trail down. And I fully believe we're going to trail down. So when do I think personally that we're going to go down and revisit the 104s of the world if that happens on the euro? You know, I don't have a lot of targets like that in my head. I just kind of, this is the way I do things, but it doesn't work for everybody. And I'm a big fan, by the way, John, of combining different mantras. Like I listen to Basil, I listen to Steve Rhodes, I listen to Larry, and I kind of use the best features that I can find from other folks to kind of like maybe, you know, use it as an overhanging, somewhat biased opinion and let the profiles also kind of bleed into that. So I'm just kind of waiting for step by step. We don't know. I know you're a big fan of this. You said assuming. Yeah, we don't know what's going down there. I just kind of like to let the inflection points allow me to orient stops, in this case buy stops, and sell resistance and sell breakdowns based around that weekly looking relatively ripe to me on the short side, just as well as you probably look at it, and just letting those shorter term profiles regulate the trade down. When I start seeing some technical damage on the dailies, like in this case, you know, if we got back up, you know, that 112.25 area has been a big number for me, you know, and now we've got a new profile, and that number's, you know, a big number, and then there's a number at 112.73, 74. If we start breaking those areas up top, I just have to be stopped out, me personally, at that stage. You know, I mean, that I know I can always get back in. I know I can wait for that 114.69 area to be hit again. And I can also wait for us to get back down at least into the balanced area of the current profile. And we can also wait until we break down. Now, what the euro is doing right now as we speak is starting to gravitate and break down below our current, fresh, new profile. So I'm just taking it day by day. John, I don't really know what's going to trigger that massive sell-off, but I know that, you know, we probably want to be short this thing rather than long. That's where I think the leverage is. And I'm just trying to block out the long side right now.
John, thanks so much for addressing that. That's very helpful, going through that thoroughly. Say, I might wrap up and just ask you something.
If you can hang around till after the break, we can continue this, because I think this is very interesting. I think other people too.
Yes.
Okay. Well,
so much.
we got about 10 seconds before the break, guys. And John's going to hang around for Philadelphia. We're going to chat a little bit more, probably move on to another instrument, I would assume. And John, I want to kind of, you know, talk about the scanner a little bit with you on the phone, and let's kind of kick that around too, because I've got some interesting things that have happened that I want to actually ask you some questions on that, you know, the scanner kind of predicates. So, guys, we'll be right back.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the show. I think we lost John from Philadelphia. If he's on, I'd love to hear his voice again. I guess we dropped him, unfortunately. Okay, so let's take a look at the S&Ps. You know, this is something really, really interesting, and I'm going to walk you through this. We looked yesterday at this 60-66 DMZ area. It's like, thank God we kind of rallied back up into this inflection point area. And I apologize, my microphone settings may have been a little quirky before. We tried to adjust them on that break. So if it doesn't sound good now, it may never sound good. So let's take a look at something that was happening intraday yesterday. I want to go into our scanner. I want to go into the index section. And, you know, we've always got the globe here, these 16 indices. We're actually adding on the ETF side, we're adding another 10 ETFs, maybe 11. Real quick here, we're just trying to figure out what's the. If you guys, by the way, if you have a favorite set of ETFs, I mean, we tried to look. These are the generics, SBDR kind of household names. But if you've got a set of ETFs that you guys really like, I mean, please email us and we'll try to get those in. And we'll take a look at all of them, and you know, hopefully at some point we'll have just a massive grid here. But we want to. You know, having the emerging market ETF from Goldman Sachs or whatever, that one's like 700 instruments to calculate that, and we're probably not going to do something like that. So try to be reasonable when it comes to the amount of instruments that are in the ETF itself. You know, these require a ton of resources to calculate this information on a minutely basis. You know, so that being said, what happened yesterday? And I was on the phone with a couple of folks. I'm going to pull up our S&P 500 section. Obviously, we've got negative breadth here pretty much across the board. We haven't opened this morning on a lot of the internals, so this could, the shorter terms could flip-flop around. But what was happening yesterday is when I was looking at these breadth numbers, and these are calculated, it's a 60-second update, and trust me, we really can't do it any faster. There's a 16-core Xeon multi-threaded processor on each one of these servers, and it's a tough row to hoe for those things. So we kind of cut it back to minutely updates, but I think that we could probably get away with 3-minute updates. But anyway, so when we were looking at this, I was noticing, and you guys have access to this on the TFNN network now. Please do yourself a favor, go get a demo. Doesn't even cost you a credit card, even outlay or anything. Throw this thing on your desktop, and we got a couple of videos, and there's some help sections and things like that. It's also got like a paragraph kind of walkthrough that's automated based on what's going on here with the profiles and the breadth, and you can kind of get a global kind of feel here with pinpoint inflection points. But as I was looking at this yesterday, I was noticing on the 240s when we were trading about 2054, we had our 240-minute profiles, and we were right in here, right? And this is really cool because I can blow this up, and we were right in here. My times are a little bit different than you guys. Let's see, it's 4 o'clock here, so let's go back to 4 o'clock. Yeah, it's about right in there. We started getting new boxes attempting to appear below. I thought something was wrong. I mean, we had 236 instruments, new box attempting appear below out of 500. And if you do the math, that's almost 50%, right? So we were in the high 40% area of new boxes attempting to appear on 500 instruments out of the S&P. So what does that mean? That means that, and you got a quick view of this right here in the speed dials. There was a big yellow section there. That means that there's new demand areas attempting to appear on a short-term basis on basically half the stocks in the S&P, which means that at the very least, a lot of the concerted effort of the S&Ps is to output on our algorithm a new demand area, which means that we're getting a new balanced area that relatively quickly a lot of the stocks in the S&P will fall right into. So what does that mean? That means that we're going to, on a short-term basis, might have a little bit of a trading range. And then when we kind of continue to look at this and kind of figure out where we're at, I mean, this was right in here yesterday. So just as, we kind of found some new inflection points on quite a few on the 4-hour, bar chart, we were able to kind of put a stake in the ground for some support for a while, right? I'm going to talk a little bit more about this when we come back from break. And this was one of the cool innuendos that's delivered from the scanner. We'll be right back, guys.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
If you're like me, you're always looking for ways to diversify your financial portfolio. Everbank's innovative Market Safe CD can help you diversify while protecting your principal deposit. In fact, Everbank unveiled a new 5-year market-safe power metal CD, which combines the power of gold, silver, and copper. Metal prices are currently low, so this CD could really deliver. Consider the facts. You get exposure to 3 valuable metals in one index CD and have the potential to earn up to 45% capped upside payment at maturity if the metals increase in value across annual pricing dates. And should they decrease? No worries. There's zero risk to your principal here, as you still get 100% of it back. Keep in mind, returns are based on CD performance. No annual percentage yield or periodic rate of interest is paid on the CD. Intrigued yet? The July 9th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is a member FDIC.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Show. I think we've got a caller. Is there a call on Bob from Hartford, Connecticut?
Yes. Good morning, John.
How are you, Bob?
My question was, I'm doing all right. I'm actually short the Dow right now, and I'm thinking about if I need to bail out.
You want to talk about that, or you want to talk about the Dow, or you want to talk about something else?
I'd love to, but my question is really about the Chinese market, and since you're over there, you have a better pulse of that. I was wondering if what's going on, and if the slide has continued, or there's still fear out there, or there margin calls, or what's going on, and how that's going to spread across the ocean to the Dow this morning, in the next few hours.
Yeah, I've got a bunch of friends that are in Hong Kong and Tokyo that are not nationals. There's British guys that I know, and they're some guys. Some of them went to UCLA, and they're not entrenched in Chinese culture actually, but they definitely have their finger on the pulse of what's going on in Asia, and they got a lot of money at stake. So I kind of take their words at face value, and The action of the Shanghai, let's just talk about that one for starters. The action of the Shanghai, as you know, we had just an incredible run up. This thing went from 2,300 to 5,300, and that is about 150% rise or something like that. it's not like these markets, and I think people just have to kind of step back and remember this. I mean, when these markets go this hard, this fast, it's not like there's no free lunch. They don't go up and plane off and go up again and plane off, and there's ultimately going to be some volatility for that type of move up. I don't necessarily think that I think we've got some technical damage, and I think if you've been watching the show recently, we've talked about the 4450 area, we've talked about the 4200 area. We're below both of those, and we've actually had closes below both of those numbers here, and that's kind of like, okay, we got to sit on the sidelines, and we got to either at bare minimum get back above and cross those borders to start thinking about the long side again, or just get some new profiles to appear down below. But right now, we technically look bearish to me, but if you look at it, I mean, considering what I've said earlier, I mean, is this normal volatility in a run up like this, and are we going to have another kind of move straight up here? I think that from what I gather and what I see with retail traders in Asia, they're not as, and again, no fault of theirs, but they're not as analytical. They don't go out there and try to do the research on, Larry Pesavento, the Fibonacci stuff. I mean, it's like market profile. There's quite a few other hosts out there that do some great work, especially on TFNN network. But these guys, these traders, so-called traders in Asia, they just trade price. They don't really, there's not a lot of extra thought put in it. I mean, the thing's going up, they're going to buy it. The thing's going down, they're going to sell it. And that's the kind of mentality that took this Shanghai up. It's like, what did it increase? $6.5 trillion in this run up? Is that the number you're hearing?
It's an incredible number. It's a ridiculous number, and I'd love to make some money off of stupid people that don't do their homework.
I hear you.
So,
yeah. So do I think? Yeah, do I think it's over? I think that they've gotten some people out of the market. They've caused some pain, and you're right, thinking about margin calls and things like that, and people trading on margin. I can't say that this thing's just going to come back down. I don't know if that's possible. But right now, the key numbers that I'm looking at to get back in the water, especially on the long term, are 4,200, 4,206 to be exact. And then when that starts happening and we get a weekly close above that number, I'm not opposed to even taking a couple of long stances around there, because I don't know if this is totally over. I mean, we've had a lot of things line up here. I mean, the Chinese numbers. I mean, the Greek thing, the fear, which is really not even out there in the golds, the golds and the treasuries of the world right now, which is really weird. So do I think that Shanghai or some of these Asian indices have a chance to kind of get back on the horse and go north? You know what? It's possible. I mean, I don't think the Chinese stock market's going to come back down to 2,000. Put it that way. I think you got some great trading opportunities, but I wouldn't get back long on the long term again until we again cross some of those numbers I just spoke of.
Okay, quick follow-up question.
All right.
There is a leveraged ETF, the Yin and the Yang. I believe the Yang is the short down bet, YANG. I'm hesitant to get into it because I'd love to get into it, but am I going to be able to get out of it? Is there liquidity? Is there, is the government going to do something really weird to bail out the whole market? So, what are your thoughts?
Yeah, that's another thing. It's like, like you're talking about, you'd love to take some money from stupid people, and I'm all for that. I mean, there's a net, or there's a net zero, put it that way, result of all this. And when you're talking about the government stepping in and doing things, that seemingly can happen relatively quick in Asia, especially China. So I've never traded YANG, but I'm looking at it just by the action to kind of, this will be a scary instrument to trade in my book. I mean, that's a daily situation. it's like a sawtooth situation. I mean, this is crazy. I mean, I think you might be able to find better ways to trade, the short side of the Shanghai other than this. Do you have any? Have you thought of any other ways to take advantage of that other than this particular ETF?
No, other than try and short the Dow, which really is a very inefficient way to do that. But I just thought that the fear and the crowd mentality would pull all the world stock exchanges lower. But I don't know, where it's hard to read the mentality of the crowd, and fear will move the market faster than it will move the fastest. So, but yeah, I'm a little hesitant about that ATF, and it's probably going to be more like a futures instrument than a leverage ETF. So, I haven't gone there yet.
I'll tell you what I can do for you. Is I can get Joey Zhang. I'm actually going to see him on Saturday night in Hong Kong. He's one of the biggest brokers. He owned a brokerage firm called Religare, or actually Religare bought that brokerage firm from him. He kind of punched out. He's a in the know guy, and he brought one of his. You could look this guy up. His name is Ed Brogan, Brogan. He was probably half, and I'm not joking. He was half the top transaction volume for a while. He ran the biggest fund in Japan for 10 straight years. But he brought Ed over here with him to our office. And, I'll get Joey back on maybe even tomorrow night if you listen to the show, and we can kick it around from a very, very high-end professional standpoint on these topics. And that would be a lot better than me kind of conjecturing a lot. It would. You'd really get some things from the horse's mouth, and I'll get him on tomorrow night if I can.
That'd be great. Thank you very much.
Awesome. And thanks for calling, Bob.
Okay. Good luck.
Okay.
Bye.
Okay. Bye. Do we have another caller, Paul?
Yes. Hello, John.
Oh. Hey, Paul. How are you?
Hey, John, calling from Wolfpack Land. Is it possible, from your vast expertise in terms of observing the Fed put, is there such a thing as a Valvano software program to anticipate, what levels would they put stops into the market of the indexes and also of the Forex?
Okay, your question is can you repeat the question one more time? And I apologize, I couldn't hear you. You were breaking up a little bit.
Well, I was sort of submitting a scenario, the David and Goliath scenario. It seems like the Fed is putting stops or puts on the market in terms of the Forex and the indexes, like, with the, Greece maybe shutting down or getting booted out of the euro. It seems like the Fed is stepping in and saying, it's only going to go down 3%, or it's only going to go down X percent. As long as you've been trading, what have you observed? At what point does the Fed step in and they're going to say, hey, the buck stops here? They're not going to let it go any further, or in terms of the indexes and also the Forex?
Well, it's an interesting question, and thanks for asking that question. But my historical experience on this is kind of bizarro world to me. I mean, it confounds me and Tom and everybody else that I've talked to about this that's on the TFNN networks. Like, basically the Fed and the U.S. government's concerned seemingly more these days of keeping stock prices higher than actually what might ultimately be good for the economy. So and that's a very long-term view that they have to kind of keep their arms around. So to answer your question, when would they step in and start supporting a pullback? I think we've needed a healthy pullback, just like a lot of other folks for a long time. But they're, whether they got Yellen's kids in a closet feeding them through a hole, or whatever, however they are trapping her into saying what she's saying constantly. There is a change in what's going on global, economic relationships. We used to have a lot of disconnects in countries doing business with each other, and that was a lot more things were internalized. So I will give her that, and I will give kind of the way that these latest ideas about how to rig the economy or rig the stock market go. But we've got changes going on now that we have never had before. I mean, we've got like a normalization right now. I mean, I'm in the Philippines, case in point. I've got a software outsourcing business here. I mean, we charge significantly less than what to program an Android app than what somebody sitting in Silicon Valley would command, sitting on U.S. wages and things like that. But I've noticed that these things are becoming normalized, and at some point, and how does that affect economies? I mean, how does that how do those affect margins in general of companies? So I mean, there's a lot to contend with when it comes to forethought now on these people like the Fed and Yellen, and I got to give them some kind of quarter on that. But to answer your question, like when do they step in and try to stop a market that gets out of control on the downside? I mean, I think that they're just going to use the same rhetoric. They're going to come in and say, hey, economic conditions have changed, and we've got our finger on the trigger again, and we could push out this rate hike thing to 2018. I mean, bolster. And they've used that bullet so many times, and it's been a very positive reaction, as you're aware of. I mean, all they have to say is that they are becoming hesitant on raising rates. And it's just like that same thing I always say. It's like, if it ain't broke, don't fix it. Come to work, turn the rents the same way. Take your ball home, come back again, and play the next day. I mean, these are time-tested, little doohickeys that they pull, and they work. And I think that's probably going to be par for the course moving forward.
Yep. Well, John, just listening to you for quite a while, you seem much more astute than that. I mean, it's sort of, if you have Michael Jordan on your team, and you don't put him in the ball game, it's sort of like, and you lose the game. I mean, what's going to happen to you? So if the Fed, if they have potential for stopping the market decline at 3%, and they don't do that, and, for example, a lot of people, there's been studies saying that the Republicans were thrown out of office in 2008 because the market declined and the Democrats stepped in. Whereas if they had protected the markets to, a higher level, then, possibly the Republicans could have remained in. It just seems like, in all the time that you traded, and even your comments, I mean, you can actually predict that the Feds, I mean, they have a lot of tools. And there again, if they're not putting Michael Jordan in the game with their tools, if they don't use these tools, then they're going to be, quote, crucified. And I think over time, just listening to you talk, you observe those levels. And there's a lot of studies saying that just technical predictions of the markets or technical trends is hocus pocus. And a lot of the reality is, the Fed's going to say they're not going to let it go up too far, and they're not going to let it go down too far. What is that past history, and how do you predict it going forward?
I tell you what, we got to go to break. Can you hang around? I'd love to talk more about this on our last segment.
Okay.
Great. We'll be right back, folks.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi, guys. Welcome back to the show. Paul, are you still with us from North Carolina?
Absolutely.
Great. You in Raleigh?
From Raleigh. I'm not actually in Raleigh at this second, but I'm from Raleigh area, yes.
Yeah. All right. That's homey. Awesome. I love it. People don't know how nice a place that is to live. It's a really fantastic place, and it's just, man, it's a diamond down there in North Carolina. There's two things I want to say left. One of them is, that traditional relationship between, fund managers usually try to manage a currency hedge. They look at the treasury market and they, invest in equities, and that balance between those three things are how people usually run money. I think a lot of these normal relationships have just gotten kind of like out of whack. I mean, and I don't know how else to say that. And when you talk about, what the Fed's going to do to try to correct the situation, I don't know. That turn the rents the same way. They can come in and try to save the day all the time, but at some point they're going to have to look at, what's the best thing for the economy. And I think at some point it's going to be detrimental for them to keep, for lack of a better way of putting it, just propping up the stock market. So
well,
what I wanted to say,
Precisely, John. What I'm asking, almost opposite of what you said a few minutes ago about procrastinating the rate changes. After the markets were down with Greece, one of the governors, Fisher, came out and said that it's not in the best interest of the markets to allow interest rates to remain at zero, or essentially he was saying it's not in the best interest of the markets to allow the dollar to skyrocket. So it's intentionally implying that he was going to do everything the Fed governors could to prevent the dollar from skyrocketing. It was more beneficial for Europe, et cetera. So essentially somewhat opposite of what you were saying 2 minutes ago. So therefore, they're essentially putting the put in the markets because they have Michael Jordan on the team. And if they don't use those tools, like they have, then there's going to be consequences. And it seems like there's a past history of predictable pattern. Okay, well, the market only went down 3%. How come they didn't go down 15% on Monday? It's like, in your history of what
you brought up I think you brought up the most glaring point is when you talked about 2008, you talked about the Republicans, and I think the Democrats or Obama or whatever, if you think that there's not a relationship between Yellen and the administration, and I'm pretty sure you probably believe that there is some kind of relationship there. It's politics. They're it's like musical chairs. They don't.
There's an actual study saying, in comparison source, he crashed the pound. And there's actually studies that came out and said that he crashed U.S. markets, to throw the Republicans out because he had a lot of money invested in the Democrats. And, he didn't want the Republicans there anymore. So it was more beneficial in him, to crash the damn market, so to speak, and he had those tools. He had Michael Jordan on his team. He had, many Michael Jordans on his team, and he used them.
Yeah, but I don't think he took on that amount of risk just to change venues for a political party.
It's not a risk to him. He's short the markets. He's making billions from other people's stupidity, like your last caller was saying. It's not a risk to him. That's exactly what he wanted. That's what he wanted to have.
Well, I tell you what, we got 15 seconds left, and what I was ultimately going to go into was I don't try to Jimmy Rogers, shorten notes, whatever, 8 years ago. You get murdered doing stuff like that on fundamentals because you never know when the things are going to happen. I strictly pretty much reside right now in our scanner, and I let those disconnects happen and just try to let those simple day-to-day things kind of guide me through what I'm going to do. But I really appreciate the thoughts that you have put into the conversation today. So, man, call in tomorrow. This is a great thing.
Okay. All right.
Thanks, Paul. Guys, stay tuned to TFNN.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.